All right, let's start. So just one announcement. We have on October 5, Thursday at 4 o'clock, it's USA Day. So an incentive, I really want a lot of people there because we're trying to keep that relationship with USA strong. They hire a lot of our students, including actuarial science majors, a lot of finance majors. And we have some UTSA alums that are really high up in management at USA. So we want to keep that relationship strong. So if you can make that, make it. I'll give you one free absence day in addition to the three you already have. Hopefully you'll be here every class anyway, but that's a good backup. Now, if you're in two of my classes, you have to pick which class you want it to apply to. You can't double dip. What they're going to do is introduce USA, and then they're going to break in the tables. The finance majors, there's three different areas that finance could be interested in. They have finance and accounting jobs, they have risk management, and they have a product development, which is kind of somewhat of their data science. The actuaries could do the actuarial science and do the data science one as well. So those are really, really good. Bring a resume. They've agreed to keep they don't normally shut down their applications before that date, but they agreed to open it and keep it open past this date. So it's a good chance to come in and introduce yourselves. It's a good company. It has a lot of very impressive people working there. And then at 5 o'clock, the Insurance Council of Texas, and they'll also come and speak to this class for a little bit at the beginning. Even though it's the wrong insurance, it's property and casualty, they can still speak to it. We're trying to get more insurance companies come to USA. So right now it's USA and there's really not a whole lot of others. So the State Farm, Allstates, those type, and some of them have some pretty big operations here in Texas. So that'd be a good one to go and see what they have to say. We'll have free food of some kind in there. I got to coordinate all of that. I think the ICT might bring pizza or something. So hopefully, are y'all gonna come? Some of y'all, yes, show up. So you don't have to necessarily stay the entire time. Although the Insurance Council in Texas, that one will probably be more of a presentation. So all right. So I sent y'all these problems. This one's closer where the market is today. This one's a little further away, but and this one's 8 years. The first one's 10 years. This one premium's 400,000. So just make sure you got those inputs. So I want to work them. So we'll do this next Tuesday for the exam. So you'll get one problem like this, just one. And after you finish, you can leave. So since the essays are open book, you're taking that time to write the essay. So that's really class time that we would have done in class, but so we're essentially going to have 30 minutes of whatever. You can stay as long as you like, except for I got a class at 7:30. If it takes you an hour and a half to do this problem, you probably don't know the problems. So you're probably, some students, they like, man, if I sit here another hour to come to me, but that's probably not going to happen. So, but I'll give you the entire 75 minutes if you need it, but I do have to go to my 7:30 class. All right. So let's start with this first one. So the first thing you got to do is the value of the guarantee at expiration. So that's step one. Is that large enough for you all to read? So the premium's $400,000. And at expiration, it's going to be time because it's a future value. And we're guaranteeing them 1.5% for 10 years. So make sure you can do this in your calculator. You don't have Excel on the exam. You have to do it in your calculator. Know how to use parentheses and the exponent keys. You should have a Y sub X key somewhere on your calculator. Does anyone have the number before I hit enter? I was hoping y'all would have worked it in it, some of y'all in advance, but we'll see what y'all get in class.
164,216
Okay. On the exam, you can round the dollars if you want to. I'm not going to round it all in Excel, so I might get slightly different answers, but on the exam, you can just say 464,216. All right. In fact, I'm going to do that. So 464,216. Any questions on that? So you better have that much in 10 years, or you're not going to, the person can be upset because you guarantee them 1.5%. Step 2 is how much bond to buy today. So the first one was a future value problem. This one's a present value problem. So here what you're going to do is take the 464,216, and now you're going to divide by 1 plus, well, the bond's going to make you 3.8%. See that number down here? So I make it a zero coupon just to keep it simple, because if you have cash flows to reinvest, that can change the numbers. In reality, insurance companies just manage that risk. So 3.8% for 10 years. So if someone will figure that number out. The class video, I'll take all this silence time out. You got it, Jacob?
$319,703.
Okay. 703. All right. Everybody seen that? And that's your answer to the first question. Question A is at 319. Because question A asks, how much should the insurance company purchase in the bonds to be able to meet the guaranteed minimum? So you'll see we did that. They need to buy 319,000 worth. So that's the answer to A. All right, and then step 3 is how many option contracts to buy. And we're ignoring the fact that option contracts have 100 options. We're ignoring the 100. So don't even worry about the 100. Just we're doing it. I shouldn't even say option contracts. How many options to buy? Then it would be accurate. So you're going to take, how much money did you start with? 400,000. That's what the customer came in with, 400,000, but you're only investing 319,703. And each contract costs $940. So it's that $81,000 that you have left over from the 400,000 divided by 940 is going to give you your number of contracts. That should be an easy calculation.
Yeah, 85.42 or 85.
Yeah, so on this one, you can round up or down. Doesn't really matter. I'll just keep rounding. I generally round up, but can't always. I made that mistake once at USAA. I rounded up, and the compliance people said you're a fraction of a contract over your policy. It's like, yeah, it's like $20. It's like they had to write on a letter to the USA board explaining why I was over. Like, well, I just rounded slightly up, but yeah, I don't make that mistake anymore. But here, it doesn't really matter. 85 or 86 will be fine. And that is the answer to that question because that's what it's asking. How many options did you purchase today? And then step 4 is complete the table. So you just kind of. So the table tells you here's the ending value of the S&P 500, 975, 3,800 is where we started, and 12,900. So S&P levels, 975, 3,800, 12,900. If you look at the table, the first thing you have to do is figure out the annuity. I think that's what I call it. Oh, I'm sorry, the bond portfolio. How much is that bond portfolio worth? So that one's pretty obvious because we purchased $319,000 worth and we invested at 3.8%. We know it's going to come out to 464,216. You know that's going to have to be the case. That's your guarantee. So that you can just put in that column, 464,216, the same number you've already calculated. Doesn't matter what the stock market does, you're going to have that, which is part of the guarantee. It's the worst they're going to do is end up at 464,216, which is a 1.5% return. Y'all stop me if I'm getting ahead of you. The next part is the option. So remember the options, the gain is going to equal the max of the stock market minus the strike and 0 times the number of options. Very famous function in finance. You can use an X or a K, doesn't matter. X for strikes if you're a bowler, or K for strikes if you're a baseball player, but S minus X. S just means the value of the underlying. S really stands for stock, but here it stands for stock market. So we got 975, 3,800, 12,900. So in this one, we have the max of 975 minus. Now, what was our strike? So if you look at the strike, it's an at the money put option. So the strike's going to be wherever the S&P was when we entered this, and it was 3,800. So the strike's by definition, because it's at the money, the strike is 3,800. So you got the max of 975 minus 3,800 and 0 times 85, and that's just going to equal 0 because 975 minus 3,800 is a negative number, so the max of that is 0. So that's just going to equal 0.
On the exam, do you want us to write them all out?
You don't have to, but there is an advantage to writing everything out. That way I can find your math errors. If you don't write it out and it's just the wrong answer, I don't know if it was a math error or you don't have to write it all 3 times, but I would write it at least once so I know you know the formula. I know there's exam anxiety, and so you transpose a number or whatever. So if you get 2 out of 3 right and you see to show the formula, I'll probably give it. I don't count off for math errors unless there's sometimes I count off for math errors when it's obvious it's a math error. Like, there's no way that answer could be the right answer, but in this one, you know, I'll probably give you credit. Say for here, it's the same thing. It's gonna be max, but here it's 3,800 minus 3,800 and 0 times 85, and that also is gonna equal 0. And so the last one's the key. It's the max of 12,900 minus 3,800 and 0 times 85. So here, someone let me know what you get once you.
773,500.
That sounds good. So here we have 0,0773500. And again, I'm just rounding everything to the nearest dollar. So now we have the equity-linked annuity. Equity-linked annuity is nothing more than just adding those two things together. It's real simple. Just add those two things together, and you're going to get the same number twice. If the market doesn't move, you're just going to end up with a 1.5% return. And then that last one's where you're going to get the big payoff from the option. So that gives us the bond value, call, option value, and then equity-linked annuity, just add the two across. And the last two columns just ask for returns. So a return is going to equal ending value divided by beginning value raised to the 1 divided by n minus 1, a real common formula in finance. We use it all the time. I'll put this Excel spreadsheet on Canvas if I remember. If I remember to put it on Canvas, and if I remember to post it, because you have to, everything's 2 steps with Canvas. So if you don't see it, remind me. I probably just forgot. All right, so again, you already know these first two, don't you? What are they going to be? You don't have to calculate it. I mean, you could. Yeah, it should be 1.5%. There may be some rounding issues. But I mean, it's essentially 1.5%. So on those, you don't have to calculate it. You can just put it down. Here, I'd go 2 decimal places, but you can just write it down. So really, the only issue is this last one. So we got 12,37,716 divided by. So just know that beginning value is that 400,000 that you came in with, raised to the 1 divided by 10. And if anyone gets that, let me know. I'll wait. Have it?
96.
Oh, what did I do wrong? Is that 40,000 instead of, no? What did I do wrong? Did I have a typo in here? 1, 2, 3, 7. Ah, all right. 11.96%. Everybody agree with that? You know, I do in calculator. I haven't touched a calculator in quite some time. And you won't touch a calculator after you graduate anyway, but I wish we had Excel on the exams one of these days. All right, and then you have the S&P returns. It's the same thing. We know the beginning value is 3,800. So here, here you have 975 divided by 3,800 raised to the 1 divided by 10 minus 1. So minus 12%. Here you have 3,800 divided by 3,800 raised to the 1 divided by 10 minus 1. We better get 0% hopefully. And here you get 12,900 divided by 3,800 raised to the 1 divided by 10. And if I set the problem up correctly, it better be higher than 1196. And sure enough, it is. It can't be lower unless, I mean, it could be if I picked the wrong premium, but that'd be too good to be true. I'd be buying a lot of that product. Downside protection, you can beat the market. That'd be a really, really good product. Sounds like a structured note. That doesn't really exist, maybe. All right, and then you got to graph it. Let's see if I can do a graph. Yeah, it doesn't quite give me the graph I want. So I don't know if this will work. We'll try it. Nope, that doesn't work. X values, series Y values. Bill Gates cannot get this right. Yeah, you want this to be a straight line. If you can somehow get it, it should be a somewhat of a straight line. But anyway, you want something that has a hockey stick. You want, the key is you have this hockey stick at the 1.5%. The key is that at the end, it's lower than the market. You've got to have returns here, and you got to have the market here. There's our starting point, 3,800, the market 0%, we're 1.5%. The market falls 12%, we're up 1.5%. The market's up 13, we're up 1196. I'm not asking you to comment on the graph, you just got to draw it. So this isn't, there's not any essay on this question, it's purely just calculated. Why do I want to do this? You do this because I want you to see an equity-linked annuity in that protected put, long call type of structure. That hockey puck is a very common strategy. I like it a lot. You have a down, you know what your worst case is, and you get some upside. That's what an equity-linked annuity is. I love the strategy. Remember, I love the strategy, but I hate the product because the product is too complicated and there's a lot of fees that really destroy a lot of this. Now, this is price only, so you're losing out on the dividends. So there's more return. And you think about the dividends, that probably adds 2% to the returns. So the S&P is probably really up 15%. So the difference is bigger than it looks here. So you're only getting price only. So you want this graph at the end. Make sure you have the dots. This should be a straight line. I don't know why I haven't gotten a straight line. It should be a straight line. But make sure you have the graph like that. But do label the graph. Make sure you have an X and Y axis. So the X should be the market, the Y should be the returns. So that's the final question. Draw a graph with axis well label comparing equity returns to stock market. You don't have to comment or say anything on any of this. You just give me the numbers. Okay, straightforward question. All right, let's do one more. Oh, did I do the second question or that's the first question? All right, let's do the second question. But questions y'all have on that? Everybody seen where I got every number? Everything highlighted is what you have to be able to do. And then the graph. All right, so let's try the second one. So this time the premium is $250,000. It's guaranteeing 1%. Step one, it's the guarantee. So here, you're going to do 250,000 times 1 plus 0.01. Be careful here, it's to the 8th power. Make sure you have that up. I always try to check on the exam. Sometimes I'll do 8 years and then I'll forget to change the table to 8. So hopefully I'll catch all of those. If you do that, 250 times 1.01 raised to the 8th. Oh, Bill Gates. And I'm going to round it. So you better have $270,000 in 8 years. Y'all double check me, make sure. So here you're going to take 270,714 divided by 1 plus. So here the bond's going to make you 3.5%, that very last number down there. I get if someone getting those values. That look good. 205,576. So that's the actual answer to A. All right, and then step 3 is number of options. So here you're going to take the 250 that the person walked in with minus how much you bought in bonds divided by the premium. The premium here is 825. So that's going to give you that. So we're going to take 50, 205, 576 divided by 825. We'll just again round it. I get 54. Anybody get 54? One thing I always love, I work a problem in class and someone right after class comes up and points out a math error. And so now the whole class has the wrong answer. And it's like, why didn't you say something like 20 minutes ago? So we got that. X worries, y'all got that? Y'all can confirm. All right, and then we'll do the table. So our values are 1510, 3500, and 7500 are much lower because we're only going out 8 years. So here we have the bond. The bond we already know. It's going to be 270,714. Then we have the options. So you already know the options are going to be 0 on these first two. If it's equal to the strike or lower, it's going to be 0 because you're taking the current market minus the strike. So any number less than 3,500 minus 3,500 or 3,500 minus 3,500, it's going to be 0. So you don't have to really do calculations there. And to Dylan's point, you probably should completely show your calculations on the last one just to make sure you don't have a math error there. So here it's going to be the max of 7,500 minus 3,500 and 0 times 54. And I get 216,000. Hopefully somebody else can confirm that.
For the answer A, did you round?
Yeah, I've been rounding throughout.
By $7.
Yeah, you're off.
Did I just, oh, I see it. Okay. All right, good. Thanks, Colby. Caught me. Is that better?
Yeah.
All right. Yeah, if I were using the actual formulas in Excel, I would get it perfectly because I'd just be referencing them, but I want you to see the formula, so I'm typing the numbers again, so I just had a typo there. All right. Is the 216 still correct? It didn't change the 54 any. All right, and then the equilinked annuity, it's just going to be add those two together. And then the ELA return. So we already know the first two is going to be 1% because the option's not worth anything. So those you don't have to calculate. And I'm not going to do any trick on yours, so it's going to be that middle one's going to be essentially already, the answer for the middle one already. All right. And so on the last one, we're going to take 486,714 divided by 250,000 raised to the 1 divided by 8. Always double check the years. Don't just assume it's 10 years or 5 years. Always double check. And let's see if someone can confirm this number. I get 868. Is that good? All right. And then 500 return. 1510 divided by 3,500 raised to the 1 divided by 8 minus 1. Zero, and then 7,500 minus 3,500 raised to 1 divided by 8 minus 1. Oh. Divided by, sorry. I get 997 and 10. That look good. All right. And then the graph it. I'm just gonna do there's the link annuity. We add one. You have something that looks like that. You have to draw it by hand, so you have try to be as neat as you can. On that. While I'm thinking about it, let me just go ahead and put it out there. I'll put it under the exam review. And then for some reason, I didn't have to do publish all. I don't know why I have to do that. So if y'all see me put something out there, but it's not out there, it's because I didn't hit that one button. Why? Is there a reason why Canvas does that? I don't really understand, but I bet you have a lot of professors who say, yeah, put it out there. And it's like, we don't see it. It's like, yeah, because you didn't hit that one button. Yeah, got it. That should be 100% from everybody, right? No one should miss anything on that problem. You know, if you're saying the math is too hard where you're finance and actuarial science majors, that's not really that difficult math. So it might be a matter of just making sure you're practicing in a way that it sticks with you. There's a lot of math in here that's really quite powerful. This is a pretty famous strategy in finance. People love it a lot. It's not that difficult to create. So it's good to be able to do that basic math because it's a pretty powerful one. You know, talking about structure notes, that's how they're doing it. I mean, it's a real similar type of structure. All right. So I'll put out on here the I'll probably just do one assignment for the 2 essay questions. So you'll submit them as one file. That way it just I don't have to click so many things open. Have y'all figured out how to use Canvas for submitting papers? So I think you click on the grades button and you can find it in there. So you have until, what did I say, 2:30 on Friday or something, the week after next? And y'all have seen the questions, right?
You want us to submit in a 2-column format or?
No, it doesn't matter. I really do not like double space. It makes it really hard for me to grade. So I prefer single space, but the 2 columns don't matter. So the first one is on the ethical challenges. And I give you somewhat of a rubric on that one. Make sure it's in your own words. So do not do any copying and pasting from the notes. Although I didn't give you that much help with the notes anyway. Most of it was class discussions. So you're probably the best thing to do, listen to the lecture and then put it into your own words. So I don't know if you have questions on any of these pieces. And then the second one was the term versus perm, which is the more complex one because I really gave you really mixed up, you know, 2 inputs that you have to somewhat reconcile. But I gave you a pretty good summary here. Actually, this is better than the notes. So the biggest problem students have is that it's just way too shallow. There's just like, give me 3 words when I'm expecting a pretty good sentence or 2, you know, a couple of sentences, and I get like 3 words. Like students will say, and then there's stochastic dominance. Okay, well, what is that? And so, and they don't even say if it's positive or negative. And there's also the stochastic dominance issue. Like, yeah, but what is the stochastic dominance? What do you mean by stochastic dominance? The obvious thing there is to use that equilinked annuity article. You could actually quote from that article, and that would really explain to it that when the 2 are tested side by side, yeah, ELA does win, but it wins very infrequently. And when it wins, it doesn't win by much. That's the stochastic dominance. It's not 100% loss, but boy, it's so dominated by the simple strategies. So make sure you give me more than just saying the words. Same thing with information asymmetry. Say, oh, there's some students like, oh, there's also information asymmetry. Okay, you can't just list words in this list and think you got to explain what that means. All right, so the salesperson knows more than the buyer. We're going to talk about that with healthcare as well. The doctor knows more than the patient, and they make money by selling stuff to you. So obviously they have an incentive to tell you stuff to get you to buy, because you can't really question them on that. Any questions on exam 1? was pretty good about it. There's no other questions I'm going to throw at you at the last second. You know, this is the exam. If talk to people who've had me before, they can tell you I don't try to trick you. All right. So let's go back and finish up annuities here. So in your paper one, which is due after the exam, you're talking some about this, and Social Security is under pressure, financial pressure. So what it's going to pay is going to be getting smaller and smaller. There's a lot of baby boomers retiring, and or they may not be retiring because they can't afford to, but you know, physically, I mean, to me, I've seen some of these videos of people in their 80s working for Walmart or Subway. I was at a Subway and a lady looked like she was in her 90s. Very sweet. You know, maybe she was there just to take up her time, but if she was there because she couldn't afford retirement, that's just really sad. She should have been, you know, enjoying her retirement. She's working at a Subway. So, you know, there's people that's the only choice they have. She looked like she's in great shape. She was on a job on her feet all day long. I hope I'm in that kind of shape at her age, but I hope I'm not working at Subway when I'm at that age. So maybe there won't be as many people retiring because of the financial lack of preparation for a lot of people. Qualified pensions, we're to shift. This is a good thing to bring into your paper for that last article. High growth and 401k plans and a shrinking and really drop from 30% to 10% from defined benefit. And most of the defined benefit plans now are public sector. This is the private sector, but public sector. So states, big unionized workforces still have pension plans, but big tech companies, a lot of them never had a pension plan. It's always been 401k. It's just a lot easier for them to administer. You have personal savings, so that can help, but the life insurance industry has a product that actually can pay you until you die. It's very unique, other than Social Security, to be able to do that. You have the accumulation and payout. We talked about that before. If you die during the accumulation period, there can be a death benefit, but it's generally not a big part of the product. So if you look at it, so a good example of this. So generally for annuities, the industry, the stockholders, investors haven't worried that much about the death benefits on accumulation products, except for one period of time. So Hartford, y'all have heard of Hartford. They're mainly thought of as a property and casualty insurance company. See if I can do max. So do y'all notice 2008 for Hartford? Now, why did Hartford drop so much from $100 to, I don't know how low, I can't get there, but $100. Boy, can y'all, it's down in the weeds. Look at the volume. So their life insurance company is not that huge relative to the property and casualty, but it was the life insurance company causing the drop. Why was that? Well, they were selling variable annuities. You think, well, big deal, variable annuities. Well, what their variable annuities promised was that if you died in 2008, your death benefit would be either your account balance or what you initially invested. What were most people's annuities in 2008? They were in the stock market. They might have invested $200,000, but how much was it worth in 2008? It might have dropped to 100,000, 120,000. So Hartford had on their books a promise to pay people back their principal that they initially invested. And the actuaries freaked out. It's like, how do we set up a reserve for that? So think about the actuaries say, okay, we have these annuities. People bought them for 200,000. The annuities are now worth 100,000. We're not going to pay much of that out because most of them aren't going to die, but we have to set up a reserve. And to set up that reserve, we got to assume what's the stock market's going to do going forward. Do we assume it comes back or does it stay down? So they had to set up a massive reserve in 2008, and the stock market just like they didn't understand it. It's like, what in the world is going on? It was a massive, massive, massive number, and you can see the stock market's reaction to that. September is when Lehman went under, and you can just see huge, huge, huge drop. But a firm that doesn't have variable products, that wasn't a big issue for them because they were just going to pay, they were in the bond market. So it was huge for these companies. So it's pretty interesting on annuities. Most actuaries say the life insurance promise on annuities is not a big deal. Hartford found out it was actually a pretty huge deal. The stock hasn't done well coming out of that since then. So there is a life insurance side to this. There is a death benefit. It's usually not a big deal. But they do somewhat promise your money back. We're going to talk about this. I think this article, let's talk about this article now. Y'all might find this rather humorous. All right. So this article here, it's on page 32 of the notes. So this guy, Joseph Caramadre, he's looking at these contracts, these variable annuity contracts, and he notices something that exactly what Hartford found out is that people invested in the stock market did well, you got a lot of money, but if the stock market crashed and they died, you get your money back. So it's essentially a product that you get all the upside and the insurance company takes all the downside, but you got to die. So not many people die. So what kind of people are really likely to die pretty quickly? Maybe a lot of old people that are out of shape. What if you went out and found a bunch of out of shape old people who have not much longer to live, and you tell them, I want to buy an annuity on your life. If the market goes up, I get to keep all of that. If you die, I get my money back. And he paid them a couple of $1,000s to do that. So he's the one to get benefits from the annuity, but it's on these people's lives. Pretty smart, isn't it? Now the insurance company says he's ripping off these people. How is he ripping them off? Someone walks up to you and say, here's $2,000. All I want you to do is I'm going to buy this annuity on your life. How have they lost? They haven't lost anything, have they? They got $2,000 for nothing. So he benefits, but that's what the insurance, I mean, he may have done some stuff. This article doesn't quite talk about some of the other things he might have done. But anyway, I think a pretty smart guy. So an overlook clause in a contract allows him to transform a company's carelessness into personal windfall. He portrayed himself as a Robin Hood. Prosecutors in Rhode Island and insurance companies paint a very different picture. They say he was an unscrupulous con artist who engaged in identity theft. I don't know how they got that. Conspiracy and 2 different kinds of fraud. He deceived the terminally ill to make millions for himself and his clients. His can't miss investment strategy was an illusion in which he preyed on the sick and vulnerable. Again, how did he prey on them? He gave them money. That's pretty good to me. You think their families would have figured this out and said, hey, why don't we do this? It offers a window into our larger issue, the transformation of life insurance industry away from traditional business of insuring lives and the peddling. Does this sound familiar to you? Does that sound like the ethics question? They got themselves in trouble because they offer these complicated products. He said the companies designed the rules. All he did was exploit them. The federal judge hearing the civil case has agreed that his contention, he was doing what the fine print allowed. It's a variable annuity, doesn't work with the other types of annuity. Variable annuities typically include a life insurance component. With this guarantee, if the market crashes, but you die before the investment recovers, you get the lump sum equal to either the death benefit or the value of the investments in your account. So the stock market's up and the person dies, you get the higher value. If the stock market's down, the person dies, you get what you initially invested. So it's essentially free protected put, 0% worst case. And it's not a percentage of the market on the upside, depends on how the annuity, but you're essentially getting the entire market upside. The insurance industry sold $1.4 trillion worth of these things. he decided that he wouldn't offer variable annuities to clients in a way life insurance envisioned. It was too expensive. They're just whacking you with fees. So he did his research, concluded that the law did not require that people buying the annuities have an insurable interest. So we talked about insurable interest on annuities. Rhode Island said you don't have to have insurable interest in the person's life. Life insurance you do, annuities you don't. Why? Because it's an investment. The life insurance is like this side thing, just kind of thrown in there. Actuaries don't think much about it. He said, yeah, I'm going to think a lot about it. There is no requirement that the investor and annuitant be the same person. As he read the contracts, the annuitant didn't have to have a relationship with the investor at all. They could buy an annuity on the life of someone who was not expected to live long and in pocket any profits. And insurance companies, they don't do underwriting on annuities. They do an underwriting on life insurance, got to do blood tests and medical exams because they're worried someone that's about to die is going to buy life insurance. Annuities, they don't do that. They just say, hey, whoever wants it. They're assuming anyone that buys an annuity is really healthy. And what is this guy assuming? He wants the unhealthy. So he's actually going after the unhealthy. If they chose well, the account went up and they reaped the benefits. They chose poorly, the death benefit kicked in and they recouped the original investment. So you can read the rest of this, but smart guy. So one judge says it's a bit ironic that the insurance companies suggest they didn't know the true nature of the contracts that they themselves had written. That's what happens when you sell complicated stuff. You open up loopholes that people can figure out. I'm not really sure exactly what else he did. He did some things that definitely got him in trouble, like forged signatures. He actually had a whole company doing this. And then people, some of the children of these people, they were like, we got ripped off. It's like, no, you didn't get ripped off. You wish you had done what Cara Madre had done, and you didn't think to do it. Now you're just mad because you didn't do the same thing. So anyway, so you played with the complexity, you get burned by complexity. So I'm kind of glad it happened, but I'm glad he figured that out. Obviously, they're going to change their contract language. All right. These products do have tremendous tax advantage. It's not tax-free like life insurance, but it is tax deferred, and they get a lot more tax deferral than other types of insurance investment products. The payout, a life annuity pays out until you die. You can have period certain. The class after, well, pretty soon I'll go on the USA site and we'll do some annuities so you can see how they're priced. And they have a period certain. I don't like period certain. So if we bought an annuity for my mom, we'd say no period certain. Because if you do period certain, it's going to reduce your monthly income by quite a bit. So if you say, okay, I want $500 a month, but if I die in less than 10 years, I want it to go at least 10 years. It's going to reduce how much you get. Now, if you're 40 years old, probably not big of a deal. But if you're 70 years old, 10-year certain is going to have a significant reduction. Temporary life annuities pays for a certain number of years or until death. That's really not a product you would see today. So anytime you put any kind of guarantee in, it's going to reduce your income. And so you just got to realize if you're worried about your beneficiaries, you're going to talk about that in paper 1. You're worried about your beneficiaries. If you go too far in all these protections, you're reducing your income, you're going to end up being a burden to them anyways. So you want to find some good balance. If there's no life contingency, it's really not an annuity. It's just, you're just buying an investment. The annuitant, it's the person who may not own the contract, like Cara Madre. He owned the contract, but he wasn't the annuitant. The annuitant is whoever's life is basis of the contract's cash flows. There is some anti-selection because people who buy these tend to live longer. The actuaries simply just assume they live longer and charge them more for that. I wish the life insurance industry would actually underwrite annuitants, because let's say someone's 85 years old, not very healthy, and they're running out of money. if they could get a much, much higher monthly income because they're really sick. So they're probably going to die in a year, but they could live 5. An insurance company could do like a special product that says, hey, this is just for people that are really sick, but there's a chance they can live longer. And so that 5-10% that make it 5 years, they can get the money for all the people who die when they're expected. But they just don't do that. They don't look at your life expectancy. So annuities can be classified in different ways. There's individual annuities, which you as a person go buy. And there are, although it's a shrinking population, there are group annuities. Employers will buy group annuities. They usually put it in their 401k plan. So they're kind of bizarre products, but you can buy group annuities. They can be fixed or variable. We already talked about that. A fixed annuity is, it doesn't mean the rate's fixed. It can change every month, but it moves around with the bond market. Whereas a variable annuity, it's your money, you're investing it. It's not even on the books of the insurance companies. They just say, hey, we're setting this product up. You put it wherever you want to, stock market, bond market, your choice. So the policyholder takes the investment risk. Here, the company takes the investment risk, and the policyholders expose the credit risk of the insurance company. So remember, variable products have dual regulation. And immediate versus deferred. So deferred annuity is just an investment. And deferred annuity, you invest until you reach retirement. So that's just an investment. And immediate is one that says, pay us $200,000 and we'll pay you $500 a month until you die. That's an immediate annuity. And then you got my longevity annuity, which I showed y'all a couple of classes ago. Annuities can be single premium, or they can be installment. Installment are those deferred annuities. Installment means you pay a premium month after month after month for several years. But single premium, so who would have a single premium? Who's going to walk in with $500,000? Well, probably someone who just had a loved one pass away and they got the life insurance, and now they have the life insurance proceeds, and they're going to take some of that proceeds and buy an immediate annuity. So an SPDA is a single premium deferred annuity. So you're going to retire in 40 years, but you want to buy an annuity and you just want to give the company $300,000 all up front. Kind of, they do sell these things. Again, it tends to be someone who just had someone die and they want to invest it. So they have a life insurance payout of $300,000. They just, for some reason, put it with the life insurance company. SPIA is, so SPDA and SPIA, SPIA is one premium and you immediately start getting payments. All right. And we sold a lot of these for some reason, and they sold these, but it wasn't ever talked about. An annuity can be single life or joint life. So single life, there's only one life. Joint life, it can be whenever the second person dies, that's when it stops paying. Or it could be in the first person who dies. It can be a pure life, which means there's no guarantees. You give them $300,000 a day and you trip on the way out and die, you get nothing. That would be a pure life. If yours is period certain, you have some guarantee. It's kind of a refund feature. Over 5 or 6 years is not a great a deal because you're essentially making 0% over 5 years, but at least you get your money back. Something that's become much more popular, and we'll see how many companies have done this, is a market value adjusted annuities. And what companies say here is, we're worried about the hot money that comes in. People that are buying annuities just because their rates are really good, but as soon as CD rates get high, they're going to take their money out and go to banks. So what we'll do, we'll give them an annuity, but if they take their money out, we have the right to penalize them for how interest rates have changed. So if interest rates are up and they take their money out, then they may only get 90% of their money back. That's a market value adjusted annuity. Not too popular for the annuitant, but very good protection for the insurance company. Protects them from hot money leaving at the worst possible time. IRS has distinctions of what's qualified, what's not qualified money. Qualified, like a traditional IRA, you can get deductions. So even if you don't get deduction, you do get some pretty significant tax deferrals. So every company has their own titles. So if you go in and look, I've been surprised going to USAA because there's always new products up. I'm not even sure if they're new products. It's the same product with a new name. They keep trying different products. So what a lot of companies have started using the term personal pension. Kind of the thought is, well, your company doesn't provide a pension, but come to us and we'll create a pension for you. So that phrase has come around quite a bit. There's some things like EGAs, which are really nothing more than bank CD accounts. There's really no life contingency on those at all. So, you know, they have all these different titles, but the ones that are, I think, truly insurance products are the ones that are dependent on the person's life. And we talked about equity-linked annuities already. It's just another expansion into the investment market. It's not regulated by the SEC. It is not dual regulated. The assets are actually on the insurance company's books. Unlike variable products, they're actually on separate books. The SEC was looking at regulating these, and it was like imminent. It was going to get passed, and to the last second, some lobbyists won some congressman over, and last second they didn't do it. But it was really, really close. So we already talked about these. The payout patterns, the marketing practices. When you say you get the returns of the stock market without the risk, that seems, you've already seen that's pretty fishy way to argue it. We already talked about the complex methods for participation. So why would the SEC regulate this? So they're going to ask, is this insurance or is this an investment? Is it insurance or is it a security? Insurance is exempt from federal regulation. It's called the Rule 151 Safe Harbor. If you're an insurance company, you have this exemption, especially from antitrust. So how do you know if you get this protection? So first of all, you have to be regulated by some regulators somewhere. So if you're selling insurance products, you're regulated. So that one's easy. The insurance company doesn't have any trouble with that. The state of Texas does regulate equity-linked products. So that's already regulated. Requirement 2, the insurance company must be bearing some of the investment risk. So with variable annuities, variable life, that's 100% shifted to the policyholder. For equity-linked annuities, there is some investment risk the insurance company is taking. And we talked about the insurance company buying that corporate bond in order to lock in that guarantee. If that bond defaults, the insurance company takes that risk, not the annuitant. So they are taking some risk. You can't have it in a separate account. The insurance company can't just invest and say, hey, whatever we get, we're passing on to you. That would definitely not be count. There's got to be some guarantees, and they can't just be token guarantees. Equity-linked annuities appear to have enough guarantees to qualify for that insurance. And the minimum crediting rates, they seem to qualify for that. Another requirement they look at, you don't have to make all 4 of these, so it's a little subjective, but this is the one I think the insurance company really messes up on. And that is, how is it marketed? Is it marketed as insurance or is it marketed as an investment? And these things are marketed much more as an investment than as an insurance product. And that seems to be their biggest concern. The other thing they look at is, what distribution channels do you use? Do you use distribution channels that are mainly insurance or mainly investment? And the last one is there any mortality risk to this product? And that one's just kind of a little subjective. So you don't have to meet all 4 of them, but requirement 3 is one where the SEC was the most concerned about. And they were definitely going to start regulating these products. And then at the last second, they lost out. All right, tax treatment. You can look these up, but IRAs, you get the tax deduction, and then it's tax deferred, and you have to pay tax when you take it out. Roth IRAs, no tax deduction, but never taxed again, assuming the IRS doesn't change the rules or Congress doesn't change the rule. I actually think Roth IRAs are highly likely to be taxed 20, 30 years from now, just because they're going to need money from somebody. You have to start taking out at certain years, except for with the Roth. The Roth, they don't care. It's tax-free forever, so take it out wherever you want to. But with traditional, since it's tax deferred, they say you can't just keep that in there to your 75 and 80, 85. Now, these rules have changed recently. They've added a few years to it. I don't know why Congress keeps tweaking with these rules, probably because that's about their age. It's like, I'm 70, give me a couple more years. So, and then what happens when you turn that age is the IRS then essentially assumes some life expectancy. So you assume you're going to live 16 more years. So you're going to take 1/16 of the balance and tax that. So, and those rules, they're pretty easy to follow, and you don't really have to worry about it because the insurance company will probably provide all that to you in a tax form. You should see the tax departments at life insurance companies. They have some very highly qualified people, very technically capable. They have to set this up. They have to work with the IT people to get it all, so that, because they're not going to just say, hey, you policyholder, you figure all this out, because it's pretty complicated stuff. Yeah, the IRS will essentially let you invest in almost anything in these variable products. And there are ways to roll these things over. Just watch the rules. I rolled my USA pension plan over into a qualified brokerage account. So there's ways you can do this. You just got to make sure you do it very, very carefully. The best thing to do is call the company you're going to do this with. They desperately want your money, so they'll help you do it correctly because it's their interest to do it correctly. If you're shopping for annuities, you need to look at surrender fees. So surrender fees means if you buy an annuity and you change your mind 5 years later, you may not get 100% of your money back. You might only get 90% of your money back. There might be a 10% surrender fees. A lot of companies, those surrender fees over about 10 years, they just disappear. At USAA, we had what we called legacy annuities, these massive annuities, and the surrender fee was $25. Not much of protection for them. People could move their money at any time they wanted. We talk about bait and switch. You have crediting rates are really, really high because this is the sales time of the year. And then as soon as you sell the product, you drop your rates. That's bait and switch. You want to look at the guarantee minimum crediting rates. The states typically require a certain minimum that you have to pay. So you want to look at that. And then what are the expenses that they're going to take out of the product? All right, we'll stop there. We'll finish up annuities on Thursday. We're getting close to healthcare. So Thursday, we'll probably spend some time on paper 2, because on paper 2, you're going to want to write as much as you can in class. So you want to come to class with your laptop. We'll talk about that most. We're going to spend some time so you can set it up correctly. All right. So once you get, it's a massive paper, but if we use class time to get it written, you'll be learning the material and getting the paper done at the same time. So we'll get 2 things done at once. All right, I'll stop it there. If anyone came in late, everybody knows what happens on Tuesday. Come at 6 o'clock. You got as much time as you need for that one math problem, and then your essays are due at 6 o'clock. I haven't put them. Have I put them out there? Did I? I can't remember. So you'll just submit those. And so you can leave after. It's not like my investment class. You had to stay after that exam. And this one, once you finish, you can leave. Thursday, we'll have the ICT. So USAA from 4 to 5, ICT from 5 to 6. And then they're going to come talk to the class as well for about 30 minutes. They're property and casualty, so it's a little different, but it's still insurance. All right. So you're ready for health insurance. Yeah.
For the essay portion, it's before, on that day, so before we start the exam?
Yeah, submit it before we start the exam here.
Like, okay, that's.
Yeah, by 6. I mean, I'm not real picky if something like a minute late, but you're going to be in here, so it's going to be hard to submit it a minute late. And you can do it before. You don't have to submit it right at 6 o'clock. You can submit it like 30 minutes ago if you wanted to. So yeah, anytime you want to. All right, so health insurance. Oh my word, what a complicated topic. I want to tackle it. I want you to know all the issues. There's a lot of them, and every single one of them individually is pretty important issue. I've added a lot of new articles, and then I keep finding more. I just found one that I'm going to give to. It's a short article. but it's stronger than one I gave you. So you'll notice some of the articles are pretty dated, and they're dated because they're really good articles, and I can't find a more current one, and nothing's changed since the article's written. So it's not out of date, it's just old. So I may find some newer stuff out there. So let's start by just kicking off this industry, and then we'll start talking about paper two, because we're going to be spending the classes writing your paper two, so we can get as much of that done. So it's going to be a coordination issue. I really recommend you bring, especially next Thursday, Tuesday won't matter, but bring a laptop. You'll see why. I'll try not to go too far. We're going to hit probably the first major topic tonight, so you can see how it's organized, how the rubric works, and then you can somewhat organize your thoughts between now and next Thursday, maybe next Wednesday after the exam. Think about how to organize this. What you don't want to do is come to class and miss out on this time to get your paper started. So where it's like we're going to be writing a paper together, hitting these issues. I find them really interesting issues. There is some controversy. I'll try to hide my biases, but I probably won't. But at the same time, I'm pretty sure I'm wrong on all this stuff because it's so complicated. I don't think anyone really has a clue. It's really tough. I do think there's some people with closer to the answer than others. I'm going to show you stuff from the right and from the left. In fact, our first two articles, the first guy's from the right, the second guy's from the left, and they're essentially saying almost the exact same thing. So it's not that radically different. I'm not trying to change your opinion because that's not my job. I just want you, my goal is to get you all those issues. So, if I'm going to tackle this topic, what's all the things I need to talk about? Because if you talk about 10 of them and there's another 10 and you fix these 10, but you mess up those other 10, you're gonna have some people really mad at you. This is a really complex issue. So we'll talk through it, how you can organize it. But health insurance is unique in that it's not entirely sold by the insurance industry. Health insurance is predominantly sold in the insurance industry, predominantly sold by life insurance companies. There are some property casualty companies that have a little bit of life insurance left over. Health insurance was one of those things we're not really sure where does it belong, in life insurance or in property casualty. Most health insurers, if they do significant health insurance, that's all they do. That's their business. So there aren't a lot of companies that do, auto, home, health insurance. They tend to do, like Hartford does auto and home, but they also do commercial. So they do both personal lines and commercial, but health insurance, it tends to be a company does health insurance, like a Humana or Aetna type of company. So there are commercial insurers out there. Most of them are group plans, which means you're going to get it through your employer. But since the Affordable Care Act, obviously there's people buying it from, is it healthcare.gov or health.gov? Isn't it healthcare.gov? Have y'all been on their site? Look down at that. Could be part of your paper. We'll talk about what you can do in the paper. So Blue Cross Blue Shields is kind of it's kind of a unique operation. You can't really tell that much difference between them and health insurers, but it's hospitals or doctors getting together and providing plans to the people who use their services. HMOs, capitating plans. The first article is he hates HMOs, and I'll show you why he hates them so much. We'll talk about that. The key with HMOs is trying to control costs with a gatekeeper. Have you ever heard gatekeeper before? So you can't go out and get knee surgery if you don't go through a physician first and make sure that's what you really need. And then there are some self-insuring plans. I think some of these are quite dangerous. Some of my friends are doing some of these self-insured plans. Well, you get one really bad claim, that whole thing could be wiped out. So it's a little bit it's dangerous on the tails if something happens. So our focus is going to be really on healthcare and health insurance, whether it's coming from any of these groups. But we're not focusing just on insurance here. We have to talk about the healthcare side. There's no way to talk about the insurance side. Now, just one warning, the first two articles, their strong conclusion is we need less insurance and not more. So just setting you up, that's the main big argument you're going to see up front. We're using too much insurance. That may not be your solution. You might want more. That was the Affordable Care Act solution, was we need more insurance. So it goes the exact opposite of what these first two are saying. You might think get rid of insurance entirely and have an entirely Medicare for all. You can talk Medicare for all in your paper, and that's perfectly fine if you want to argue that, but you can't talk Medicare for all in your paper and not address the issues you brought up about that in class. So you at least got to hit those issues, all right? The issues with Medicare for all. So I'm actually don't care if you have a strong understanding of the difference in these type of plans. You almost don't notice it that much. There is debate about public versus private. I say US versus Canada. We're going to see in our class it's going to be more US versus the UK. UK really is somewhat of the unique thing about the UK is it's kind of like the Veterans Administration. It's insurance and healthcare all rolled in one. So it's one big program that everybody's under. And it has been put forward as the solution by a lot of people, and now it's somewhat crumbling. And so we'll see some of their issues. I think it's interesting when people talk about, UK has it, it's this government provided plan. They don't have our problems. And now you're seeing they have our problems. Are just not as extreme, but they have the same problems. Every healthcare plan in the world is having serious issues. Why? Because we're aging, right? The same thing you got in paper one. The baby boomers, it's the issue everywhere. Old people are expensive. You're probably going to spend the majority of your healthcare dollars. For a lot of people, it's the last 3 months of their life. So we'll talk about that. So one thing that's interesting in this is people say US, we need to move more to a one-payer system. Well, we're already over to halfway there. Medicare, Medicaid, Veterans Administration, they may not cover over half the Americans, but they pay over half the expenses. So they're over 50% of the claims, even though they're less than 50% of people covered. That's because they cover a lot of old people. So yeah, we're over 50. If someone says, ask what's the largest single payer plan in the world, it's probably the United States. It's probably not the UK. It's probably not Canada. Probably the largest single payer plan in the world is the United States. And I have a lot of friends in the military that just like, I hate governments. I don't like government plans. And it's like, you're in the Veterans Administration. That's about as government one single player plan as you can get in the United States. I mean, you're already there. That's what you're doing. Most everybody else is covered by employer provided health care. And some of the plans you're going to see, and you're going to get my bias is that. So I'm going to shock you. All right. So I'm probably wrong, but I think we should eliminate employee provided health insurance, but we'll talk about it. How many of y'all have employer provided auto insurance? Nobody. Why not? Where's your employer provided homeowners insurance? Oh, you don't have that, do you? You may have employer provided life insurance, but it's not much. So why is healthcare different? We'll talk through that. And some people think, when I say I want to eliminate that, say, oh, that sounds far right, but it's actually far left. It's both. I forget which manual it is, but the guy working with the Affordable Care Act, he was mayor of Chicago there for a while. I can't remember his name, but yeah, you read his
Rahm
book.
Emanuel.
Ron, yeah, thank you. So you read his book. That is part of his thought is the Affordable Care Act will eventually eliminate employer provided health care. That's a perfectly reasonable approach to go, but you got to think about how you're going to do that. You're going to do that by government providing everything, or about everybody going out and buying their own policy, and it's still private. So your answer can be anything in this paper. The one thing I'm giving you in this paper is it doesn't have to be politically feasible. All right, you're going to be king. You can do whatever you want to. There's no Republicans, there's no Democrats, there's no Congress, there's no voters. So you don't have to worry about the political piece, because that does make it a lot harder, doesn't it? But you got to get it politically reasonable. So you don't have to worry about that. I just want to hear what you think is the best solution if you could do whatever you wanted to. All right. I'm actually going to skip through here, but historically, health insurance used to be much more like the other insurance. Looked a lot more like auto insurance, homeowners insurance. Most of it today, though, is employer provided. So we went from everybody buying their own plans to today employer provided. It does have administrative cost advantages. It does protect you from anti-selection. So the problem with individual policies is that unhealthy people are going to buy more health insurance than healthy people. With the employer provided, they don't care. As long as everybody buys it, they just say, hey, if you buy it, we're going to assume you're healthy and you're going to get it. So that means someone who's really unhealthy could get a job just to get the health insurance. Has that ever happened? Yeah, it happens probably all the time. But what the health insurance companies say, as long as all of your employees are covered, we're going to assume the bulk of them are not getting the health care, are getting the job just to get the health care. It's probably secondary. And we're going to talk about the tax. This is a big issue as well. The tax, there is no bigger tax benefit in the United States than healthcare. It is the single largest tax benefit. And who gets most of it? The poor or the rich? What do you think? Where does the bulk of it go? The rich, yeah, it's heavily skewed. Do we need more tax benefits for the rich? That's kind of what healthcare is. Health insurance is heavily skewed. Why? Because they have the highest tax rates. Since they have the highest tax rate, they get the best benefit of that. Portability has been an issue, maybe not as much now. We will definitely talk about pre-existing conditions and how the Affordable Care Act tried to address that. And rising medical costs, we're definitely going to talk about that. Medical costs, it's interesting. You look at the 70s, inflation was rising for everything. And you get the end of the 70s, the cost of everything else started going sideways and healthcare kept going up. So you had this wedge like that was created. I'm not going to talk managed care. These issues, you can read the class notes. I don't think those are that critically important. All right, so are y'all sitting down? So I don't want to freak anybody out. Everybody's sitting down. All right. So here's the rubric for this paper. So there's like 40 things on it. All right, so this is my organizations. A lot of students, this is also their organization. That's perfectly fine. That prevents you from missing something if you want to do that. If I were you, I'd write my paper in this order and then reorder it that makes more sense to your argument, because there's some things that make more sense to move around. But the way I have it organized, whether if you don't like my organization, you have to come up with a better approach. But I have an introduction to the problem, introduction to the host issue. Then I have a list of the problems. What's wrong with healthcare? We're focused on the U.S., but these problems, many of them relate over the rest of the world. And what are the solutions? Okay. And then you have this one line called other, and we're going to do one whole section on Porter. So on other, what I'm looking for there is you go do either find a new issue or even better, find an issue on this list and find some better article, something more recent, and talk about it. All right, I will get into that a little bit later. So how can you organize this? So my guess is you're probably gonna be best if you do this in Word. So maybe what you're gonna do is copy this. We'll see if this works, see how Bill Gates handles this. Copy it in the Word, probably with very narrow margins. And then as we talk about a section, you can have the article open. One thing you're really looking for, and this may actually be a big chunk of the paper, is to get great quotes, get your thoughts, and then get some great quotes on that section. So we're talking about that section, say, hey, well, I really love that quote. That'd be a good thing to bring in. Here's the 5 issues we talked about. I got to cover those. So while I'm in that. So what does that mean? I talk really fast. So you have to say, wait, Professor Reed, I got to get caught up. And I'll just shut up for a few minutes. You can get caught up, cut and paste. You see what I'm talking about? You're essentially going to be building out the paper. Any questions on that? That makes sense? Y'all know where the rubric is? Is it out there on Zoom yet? I can't remember. On Zoom, on Canvas. There it is. Rubric. Oh, nope, that's not it. There it is. Rubric for paper 2. You'll see that. It's an Excel file. Can you copy and paste it in Word? Does Word make the most sense? Excel's pretty painful to do stuff like that in, I would think. So you see why I'm recommending you have it on laptop. Because if I'm talking, I'm going to start with this one. We call it insurance. You probably want to have that article open. So if you see something great, you can cut and paste, copy and paste, not just so you have a quote, but sometimes you may not even want the quote. You just want the idea. And the fastest way to get the idea is to copy and paste it into your outline. I think if you do that consistently, when you get to writing a paper, it's really just a matter of wordsmithing. You're going to have all the ideas. You just got to word it so that it makes sense. Okay. Is everybody with me? I can't tell. I'll look shell shocked, but the fortunate thing is it's a lot of really interesting concepts. There's a lot of stuff here. You may have thought of a lot of these, or maybe some stuff in here you haven't thought of. The other thing I want to do, if I can get this to work, I love this movie. It's really good. It's old. It's one of those PBS Frontline Research. It's a really good movie. It is dated, but there's nothing other than the data's old. The only thing that the data is, it's the same problem. You just got to inflate it. But all the issues they talk about in here is still true today. That's what's frustrating to me about this issue is all the big problems back then are still the same big problems today. The Affordable Care Act, we're not going to talk much about it. This is not a paper on the Affordable Care Act. There's things in there that we'll talk, that definitely the Affordable Care Act addressed. But the Affordable Care Act was primarily a demand side legislation. And you're going to notice a lot of these issues are supply side issues. And that's what they're going to talk about. When you hear the guy in this movie say, I'm paid to injure my patients, what is he talking about? I get paid more if I injure my patients. That's a pretty crazy thing for someone to say. He's talking the supply side, the incentives. And the word incentive is a really important concept to this paper. What are the incentives, especially of the supply side? Is it to make us healthier? Or is it to give us more treatments? What are they trying to do? So this is a really good. The problem I have is it keeps disappearing. I got it off of PBS the first time, then I got it out of Vimeo the second time. It's out there on YouTube. It may not last very long. So if it disappears, so what I'll do is if it's still working, so y'all are really hoping it's going to work. If it's still working, I'll give you a class walk and you'll watch this video instead of the class. All right, does that sound good? But if it disappears, we can't do that and you'll have to come to class. So, one nice thing about this video is John Kim was doing a honors contract and I said, go in and take really great notes on this video and give me a Word document. And he did. So you can also use his Word document to help capture some stuff. So he did a really good job of capturing the video as well. So it is really, really good. I'll show you a little bit of it.
Maybe too thin or too rich and you can't get down.
All come to a similar conclusion. About 30% of U.S. healthcare spending is devoted to unnecessary service.
All right, so you heard that term. He said 30%. I've seen 30 to 50% of healthcare spending in the United States is wasted. If we eliminated, our health would be exactly the same. Does that sound like a high number? 30 to 50%. He said 30. He's on the low end. I'm going to show you another book that says, well, they actually say something it's higher than 50. So I guess it's 30 to 50 plus. That sounds, there's a pretty good solution right there. So where is that coming from? Is it coming from the demand side? Are we asking for too much healthcare, or is it coming from supply side? Are they giving us, we're being given too much healthcare?
$800 billion a year.
You don't have a significant blockage.
You have to remember that one person's waste is really always another person's income.
That's a great quote. One person's waste is someone else's income. You hearing the incentive there? You see why I love this movie? This is like quotable throughout. Really great movie. So excellent. The issues they're bringing up are still true today. Not much has really changed since they did this movie. So it's a great movie. This poor guy in here, this is my favorite here. This guy's really, if I can find him.
Hi everyone, Mark Barton here.
Sorry. Oh, I hate these things. Oh, anyway, great movie. You'll have to watch those stupid commercials. they make really good points. This poor guy, I think it's UCLA. They keep talking about why UCLA is so much more expensive than everybody else, and then they interview this guy, and he's kind of like trying to put a pretty face on the fact that he's getting beat up in the video. But they do make a point that there are healthcare providers out there that are significantly cheaper than the others with higher quality. That sounds like a good solution. We cost less and our outcomes are better. And UCLA is the exact opposite. UCLA says, well, but we get the most difficult cases. Well, is that really true? Or is there something else going on? All right, so you kind of see, so it's a great movie. We'll probably have to watch it here pretty quick because it may disappear again. I've never not been able to find it, so it's probably out there in multiple places, but it did disappear from one of those. All right, so I'll set that up. Great quotes. What you're going to see in there is they go treatment by treatment by treatment to make different examples of how healthcare overtreats customers. So a lot of this is this issue right here. Overtreatment, overdiagnosis. That's a big part of what this video's about. Good examples are knee surgery. Studies have shown that people that get knee surgeries are no better off than people who go to rehabilitation 5 years later. One costs $1,000, the other one costs $15,000. But the outcome's the same. Which should we do? Sounds like $1,000 is better than $15,000, doesn't it? If you're a surgeon, which do you want to do? I'd much rather do the knee surgery. Yeah, it sounds a lot more lucrative to me. So that's the overtreatment, over diagnostics. All right, so you kind of see where we're going. So those that don't have a laptop, you're going to bring your laptop, or does that work for you? I mean, can you write that fast? I mean, you could print out of the articles and highlight, but it's probably 100 pages of stuff. So, all right, so tonight what we're going to do is focus on this one thing here, just this second one, define insurable event and its impact. Okay, that's the main issue we're going to address. Has anyone already got it in the Word document? How fast are y'all? Yeah, okay. So we're going to focus right here. This is going to be Article 1. We call it insurance, and that's unhealthy. Now, one thing you'll notice with this article, he sets up what's wrong with the problem, but he also discusses the first solution as well. Because he's going to say, this is what we're doing that's wrong, so instead we should do this. So his article is the problem and solution, focus on this one particular issue. All right, but it really sets up the foundation for a lot of the other discussions. All right, so the very first solution is set up in this, define what an insurable event is. All right, I'm hoping you are staying with me here. So let's do this article. It's 20 years old. But I love it because in 2 pages, he covers a lot. He's very, very efficient with it. Now, he's the DC's Commissioner of Insurance. You might say Washington, DC, Commissioner of Insurance. That sounds like someone on the far left. He's actually a libertarian far right who was appointed by a Republican president. So he's kind of on that side of it. But the second article was written by someone, a journalist, a Democratic journalist. So you'll be surprised at how much overlap there are in these. You'll notice on a lot of the articles, in fact, almost all of the articles, if not all the articles, I highlight stuff. So you've got a lot of articles. You can get away with just reading the highlights. If you see something really interesting, you might read around the highlights. So if I give you 90 pages of articles, when you take out the non-holiday parts, it's not as much as it might look. All right. So in this first issue of define what an insurable event is and how that impacts consumption, HF is high frequency, low frequency. So we talked about that earlier in the class, right? We said you want to insure things that are low frequency, high severity. We don't want to insure high frequency, low severity events. We want to insure things that don't happen very often. When they happen, they're very expensive. That's what he's going to address. So he says the general definition of an insurable event, we actually talked about insurable event, from traffic accidents, homeowners insurance, is something that is first very unlikely to happen. What do we call that? Low frequency. Second, comes without warning. We'll talk a little bit about that. And third is something that person doesn't want to have happen. So another way to think about this is accidental. Low frequency, accidental. Here he's kind of hinting at this last one, but I'm just going to say it. It's catastrophic. That is high severity. I'm not saying there's not low severity things people don't want to have happen, but he's kind of hinting at the high. He's going to mention catastrophe here pretty soon. So low frequency, you don't buy auto insurance to cover your oil changes. It's accidental. You don't accidentally go to get an oil change. You schedule it, you drive by, you do it. And catastrophic, an oil change is what? $50 or something, depends on what grade you get. So yeah, auto insurance doesn't cover oil changes. It misses all three of those. So he says that definition applies to what? Catastrophic health events. It does not, I didn't put the italicized in there. It does not apply to routine health maintenance. You already can see where his solution's going. So remember what he said, the first arguments are use less insurance. He's already there, and he's only one paragraph in. His solution is we're using too much insurance. We need to use less of it. Yet the current paradigm, we don't use this word anymore. This was a big word, but it's got overused. But paradigm, idea, kind of strategy for the payment of healthcare tries to cover both of these. Tries to cover both the catastrophic things and the routine things. And he says, this is pretty critical, he says there's a built-in contradiction. And why is that? This is a great phrase. This is one you might quote in your paper. Not that I want to see it 40 times, but that's fine. Insurance system works best when the fewest people use it. Why? We talked about that earlier. Insurance is expensive. They got actuaries, underwriters. You don't want to use insurance unless you absolutely have to. So you want to limit it to those very low frequency, high severity events because it's expensive. So insurance works best when the fewest people use it. That keeps the costs very low. I mean, life insurance is a perfect example. You don't want to sell life insurance if, if 90% of people are all dropping dead. That's not going to be good. You want life insurance works well because especially young people, so few people die. You can get $500,000 of insurance for like $20 a month. It's really cheap. Why? Because it's low frequency. Healthcare system works best when what? When the most people use it, because it's a business. They want more customers. Checkups, tests, vaccinations. The goals are incompatible. Okay. Comments up to there. You'll see where he's going here. Now he's going to badmouth managed care. At the time he wrote this, managed care was a huge deal. So it's not as big of a deal today. Managed care, I'd say, has fixed some of their problems. I don't know if they fixed some of their problems. They fixed their complaints and I think made some of the problems worse. But anyway, he doesn't like managed care. Managed care is like HMOs. So an HMO, you're in a system. You pay like $20 for a doctor visit or something along those lines. You have unlimited coverage. It pays for catastrophic things. It also pays for routine coverage. The thought with managed care, and we'll get into this issue, is that if you incentivize people to go to doctors more often, we'll catch things earlier and we'll save money in the long term. That was the argument. We'll talk that issue later. What does he think about managed care? It's a system that satisfies nobody, infuriates healthcare practitioners, infuriates consumers, because it limits what people can do. That some treatments or services are not medically necessary. Legislators respond to public outrage by what? So we're going to talk about governments. Governments love to mandate things. You've got to do this. They like to mandate things because they forget when they mandate something, it costs money. So it's like, hey, you got to do this. It's like, well, good. We'll raise our rates 40% then. Like, well, but you got to do this. It's like, okay, well, maybe our customers don't want to pay 40% more. Whether they are really necessary or not, that in turn frustrates insurers because mandated benefits throw off underwriting. And so they're going to raise their prices. So when you cover more, it's going to cost more. But what else is going to happen? When you tell people you can use this service all you want, it costs you $20, what are they going to do? Are they going to overuse it or underuse it? When you have something cost $1,000, but you only have to pay $20, what's going to happen? You're going to overuse it. I remember so well, USAA went to managed care. I was on the committee for the pension plan and the 401k plan, but also had the healthcare, which I just sat and listened. And they did managed care. And the first meeting was, guys, I don't know how to say this, but our usage is like skyrocketed. The claims volume has just gone through the roof. What's going on? Like our healthcare costs are off the charts. Well, what went through the roof? When you have a kid that's probably got a cold, but it only costs you $20 to go to the doctor, you take the kid to the doctor says, yeah, he's got a cold. And was that a good use of society's money and time and money? You know, it's just, but that's what managed care did. USAA moved away from managed care and the costs shot back down. The other problem, and you notice in the list, this last thing under introduction is the players and incentives. All right, let's see if we can figure that one out now before we get into this. So what's the obvious player here? Well, okay, I wouldn't put them first, but since it's an insurance class, I agree that would probably be the first thing you think of in here. So who's the customer here? Patients? How do you spell patients? That's right? Consumers? That's one. So what's the opposite side of this one? Yeah, doctors, hospitals, and can we put pharma in there? We'll talk some about pharma. Insurance companies. Who else is in here? How do most people get their insurance, health insurance? Employers. Who else might be in this group that we've talked about that likes the mandate things? Government. Can y'all think of any others? So what do these people want? You might say to be healthy, but they want to be healthy if it costs them $7 million. Can we say this or not? To be healthy at a reasonable cost to them, then they may not care if it's healthy and it's reasonable cost to them, but unreasonable to someone else. So I'm not saying that. I'm just going to say they want to be healthy, but as long as it doesn't cost them too much. Would y'all agree with that? Or they say, I want to be healthy no matter what. When I heard Milton Friedman, someone asked him about healthcare. In fact, a friend of mine, we were at the conference and he asked him about healthcare. And Friedman says there's no natural limit to healthcare. It's an incredibly inelastic demand because people can't enjoy life if they're not healthy. So that's the thing that if they don't fix that, nothing else matters. So they'll spend whatever it takes. Now we're going to read some articles that challenge that healthcare actually does have an elasticity, that people actually will shop around they're incentivized. But if you're really, really sick and they can spend $7 million and add 3 months to your life, do you want them to spend that $7 million? Are you going to spend the $7 million? Probably not. Would you spend $50 if Medicare had to spend $7 million? We're going to see in that video, you're going to see, boy, I wish we could show. Sorry, you have to listen to this guy. He sounds like he's really depressed about something.
December 14, 2000.
Nice care. And that's the shift that's happening in medicine right now. It's from each physician as a standalone expert in their own right, kind of a little law unto themselves, godlike in their powers, to a team of physicians managing the complex knowledge necessary to deliver best care to a patient.
I don't know if I can find it.
We have a massive drop in unplanned C-section rates. It was associated with about 50.
Yeah, C-sections is one they're going to talk about. We're going to cover some articles on that. Why is C-section so high in one hospital and so low in another hospital? Are the patients healthier? And the answer is actually a lot of studies show they're less healthy because of that. But boy, I wish I could find this one guy. He's really, really good. Not good. It's really, really sad, but.
I take 5, you stay in your car because we're faster than you think.
All changes them. That's a
So
What happened?
it's a really sad story. His mother is brain dead. She's in a bed. She's on ventilation. Her chances of recovering are practically zero, but not zero. Practically zero. All right. The son is asked, do we keep her alive or do we unplug her? And what does he say? Someone asks you, you want to keep your mother alive? What are you going to say? Keep her alive. How much is he paying for that? Nothing. Medicare is paying for it. How much did Medicare pay? I forget the numbers, but it's in the millions. So Medicare spent millions of dollars to keep her alive for a couple of months, and then she passed away. So you ask, well, that sounds horrible. You'd let her die, but that millions of dollars could have kept maybe 500 people alive. So those are kind of choices you're making. So it's this first comment is to be healthy. I'm going to throw that reasonable cost in there. But then the question is who's paying for it? So that's what he's going to talk about. Doctors and pharma and hospitals, what do they want? They want volumes and revenues. Remember what he said? One person's waste is another person's revenue. So they want, another way to say this is they want treatments. Now, I don't want to be cynical, but the doctors want their patients to be healthy. Well, may not be their highest incentive, but they probably would prefer you to be healthy and unhealthy if they just gave you a hip replacement. But now we're going to get to Michael Porter at the end. Michael Porter's going to ask the question, can we change their incentive to be the same as the patients? Is there a way to change the system so the doctors are paid not to treat us, but they're paid based on how healthy we are and the cost? So you're going to see the value equation for Michael Porter. It's the same Michael Porter that you do fortified forces. So he gets around. Insurance companies, what do they want? Well, they're kind of interesting. Insurance is what? Cost plus pricing. Did you know that? Cost plus pricing. If their claims go up, what do they do with their premiums? Their premiums go up. All right. So let's think about this. You charge $1,000 plus $200 for profit. There's your claims. Or let's say plus 20%. What happens if your claims go up to $1,200? What happened to your revenue, the company? As your costs go up, your revenue goes up. So insurance companies, do they really have an incentive to cut back on claims? Their only incentive is the pressure employers put on them. So we're going to talk about that in dynamic, but they almost, I say almost don't care because they're passing their costs on to the employer mainly. What do employers want? He's going to talk about this. They want lowest cost health insurance without employees being mad. Their goal is to provide the lowest possible health care they can to you, so low just to the point where you quit and go somewhere else. All right. They don't want to do any dollar above that because they're wasting money. So if this plan will keep you at the company, you're happy, they'll do that plan. Now, of course, they're competing with other employers. So they got to figure out what the other employers are doing. Their goal is not to provide you the best health care you can possibly get. Their goal is to provide you just enough so you don't quit. What is that? That's a pretty tough equation. Obviously, there's this comparing each other and probably doing very similar stuff, but they're not trying to make your life as wonderful as possible. And what's the government's goal? That one's easy. They just want to be reelected. So theirs is all about image over substance, unfortunately. So let's see what he says. Let's see if he says similar things, but you may think of any of the players. That I leave anyone out? I mean, obviously you have media and other people that get into this, but I don't think they're players. All right, so let's see what he has to say about this. So there's another basic problem with the healthcare system. Healthcare services are negotiated not by the people who are affected. Who's affected? Doctors and patients. But who's negotiating all this? Insurers and employers. So the people who use the system and provide the services, they're not involved in the financial aspects of this. It's the insurers and employers. Obviously, physicians, hospitals, they've got to negotiate with insurers. So they're kind of secondarily involved. Consumers are going to buy insurance from their employers, so they're secondarily, but the decisions are made by the employers and the insurers. Now, one thing he doesn't mention, but is pretty critical, is that government's going to dictate what these groups can do. So government's going to dictate what has to be in the health insurance policy. I remember President Obama got in trouble. Well, y'all probably don't remember. What were y'all, like 3 years old when he was president? When was that? Can't even keep track. But maybe it wasn't that long ago. But he had, you know, he wishes he hadn't said it, but if you like your plan, you can keep it. Y'all remember him saying that? And he got in a lot of trouble for that. I think he was, you know, I think his intent, I knew what his intent was, because his thing was the people who weren't going to get to keep it, they had bad insurance, we're going to fix that. And some people said, no, I don't think it's that bad. I like it. I want to keep it. So that's kind of where he was kind of on the edge there. But the government started mandated for insurance to be qualified, you have to cover these things. Well, now government's getting involved in this equation as well. When the government gets involved in equations, costs go up because they're mandating more stuff has to be covered. All right, so there's a big difference between this and a lot of other types of products that you buy as a consumer. You've got someone in between you. And what happens when you're not paying the bill? You're buying the insurance, but your employer is buying the insurance. You're somewhat separated from this transaction. How can we change your incentives so that you have more skin in the game? All right, so here's what he talks about employers. Employers try to find the least expensive plan they can. Insurance companies know this. So this is the incentive for insurance companies. Their incentive is not to keep claims low to increase their profits. Their incentive is to keep claims low because they know employers are going to complain about what they cost, okay? So it's a little bit different. They're cost plus, they benefit if costs go up as long as they can get their employers to pay for it. Now, the Affordable Care Act, there's a lot of talk that the Affordable Care Act might lead employers to say, you know what? We're not covering you anymore. Go to healthcare.gov and just buy your own coverage. There was some thought that would happen. It really hasn't happened yet. It could, I think, for it to happen, you'd have to have a major employer like an Amazon or someone like that to do it. And then some others copy. I think it'd be a copycat kind of thing. I think most employers are scared to do that because the media would just, can you imagine? Walmart has canceled all of its health
coverage for its employees. They may give their employees a $10,000 raise and cancel the insurance. The employees say, hey, now you got 10,000, go buy insurance. But that's not how the media is probably going to play it. They're going to say, hey, they don't cover health. They may not cover healthcare for their hourly workers anyway. Who knows? So how are they going to do that? Well, they're going to do it by covering less. So you'll have less coverage. So how good of a job do insurers do at like the knee surgery? How well do insurers do of saying, hey, you know what? Knee surgery is not all that great. Rehabilitation is a lot better. We'll pay for that, but not the knee surgery. They don't really have that kind of power. Why? Well, what's government going to say? When health insurers are saying, we'll cover this, but not that, both parties say this. We shouldn't interrupt the patient-doctor relationship, right? The doctor knows best. They should make that decision. No one ever talks about the doctor's incentives. So does the doctor know best? Yeah, he or she knows a lot. He or she knows that he or she makes a lot more money if they operate on you than if they don't. They know that, but so that's part of the problem with this equation. So what's the solution? Now, here's his answer on the universal. He didn't say no, he just says, I don't think so. But you can definitely make that your solution, but make sure you fully talk about it. I don't think government can solve these issues any better than private insurers have been able to. Now, on the other, let me give an example of the other. So that bottom line, other. I don't get too much in the government provided kind of single payer, but if you wanted to go to Bernie Sanders' site and look at Medicare for all and see exactly what he's proposing, and you want to write that in your paper, that could count as your other. Okay, so I'm not looking for much. Go find something to add more. So we're not going to talk about his proposals. Bernie Sanders is a smart guy. I disagree with him on this, but a smart guy. If obviously he was here, it'd be a fun debate. He'd probably crush me, but that's fine. I'd take him on. But that could be one way to get, and you could do that even if you disagree with Sanders. Say, well, looking at Bernie Sanders, he's arguing this. I think he's wrong because of these reasons, or I think he's right for these reasons. You can certainly do that. But what can government do that the private sector can't? And so you might have arguments where you don't have the profits of the insurance companies. They're more efficient, those kind of things. We'll talk about that efficiency when we talk about Medicare and the serious fraud and waste issues that Medicare has. So that's not his solution. What is his solution? So where are we now? So you've got everything you need now for that first bullet from that article, okay? So now we go down to the solution. What is his solution? Are y'all keeping up with me? Those without a lot. Everybody, okay. Can y'all guess his solution? No. He's not going to say no insurance, but that'd be a starting point. So he wants health insurance to look more like what? More like auto insurance. Okay, so how does he do that? So let's look at that. To begin with, we need to recognize that we're dealing with two different healthcare needs and must cover those in separate tiers. One tier is catastrophic illness, and for that, insurance is the answer. All right, so there you have insurance for low frequency, high severity events. He says a deductible of $5,000, and this was several years ago, so maybe that would be $10,000 today. When you see the second article, you can be shocked at what he thinks the deductible should be. He's kind of, even though he's to the left, he's kind of a little wacky on the left in some of his ideas, but it's interesting. It's a really, really good article and book that he wrote. So is 5,000 too low today? 10,000? What are you trying to do? You're trying to eliminate the insurance company. What percentage of claims would a $5,000 bottom cause? Would it eliminate 90? That'd be a good statistic to have, wouldn't it? So maybe it would be 10,000 today. You would eliminate quite a bit. Would you eliminate broken legs? How much does it cost to mend a broken leg? I haven't broken my leg ever. Anybody have a broken leg? So how much does that cost? I don't know how much that would cost. Might be over 10,000. Who knows? Depends on how serious it would be. Hip replacement, you think that's got to be over 10,000 when you think, isn't that an amazing operation? Hip replacement, and you there's a lady here that had it, and she was walking around a week later. It's like, wow, that's pretty amazing. How much does that cost? I don't know. It seems pretty dramatic to me, but it worked for her and it was amazing. So I don't know what percentage it would eliminate, but certainly will eliminate doctor visits. You wouldn't be using insurance for doctor visits, checkups, those kind of things. Even the upper limits of coverage are very high. Now, HMOs have the advantage that there's no limit. So however much it costs to fix you, we're going to fix you. That might be great if you're 20 years old and you know there's some major health crisis and $1 million and they can give you another 50 years of life. Spending millions of dollars on a 90-something-year-old person, that you might debate. Remember that book I told y'all about? He said for people over 80, it's care, not cure. That seems pretty harsh, but that was his solution, that we shouldn't be trying to keep 80-year-old people alive for next year or so by spending millions of dollars. So should we cap the top? He's kind of leaving that open with the word or more, maybe even unlimited. That is because most people do not get catastrophic illnesses, right? Low frequency. Such insurance would also cover the cost of any chronic illnesses. So diabetes, heart disease, those type of things where you have a cost that's ongoing. This would still cover that once you hit your 5,000, but still those people are going to be spending $5,000 a year they weren't spending before, so they're definitely going to notice it. The second tier is for those regular checkups. What does he recommend there? This tier insurance is not the answer. So here he's going to have 3 possible solutions. Out of pocket. That's how I do dental care. I just hand them a credit card. I'll leave. It's done. No more work. Cost me $100. Big deal. Just like you do for your car. For others, an employer-based system could work with what? Medical savings accounts or health savings accounts, MSAs, HSAs. So there's different functions of these. We're going to talk more about them when we talk about the tax code. But you might have an HSA which says your employer can put $5,000 into an HSA for you. You can use it for routine medical care if you want to. If you don't use it, it folds into your retirement plan. All right, we did this with one of the entities I'm working with. And I thought it was going to work great because the first thing he said is, you know, if I don't use it, that's my money. I said, yeah. And he's like, I'm going to go to the gym and get in shape. I said, okay, that sounds good. That's kind of what we were hoping to incentivize you. And that lasted a good 2 weeks. But, you know, that's your money. So if you spend it, you lose it. So now if someone says, well, we'll charge you $12,000 for a knee replacement, or rehabilitation's $1,000 and it works just as well, would that change your opinion? That might change your opinion, right? Do I really need a surgery? Am I getting an infection? Might not work, some complication. I can do rehabilitation. If it doesn't work, I can always go back to the surgery. Would that change your opinion versus the doctor says you need surgery and you don't question them? Because it's only going to cost you $50. Now it's going to cost you $5,000. It doesn't cost you the 12, it costs you 5, but 5,000 versus 1,000. Hey, it's your money. Would that change incentives? And I'll give you my bias here. You only get one body, only one life. You don't get like a new body at age 50. To me, that's a pretty good incentive. I don't know why we need more incentives. So I'm not sure why giving people $5,000 is going to make them exercise more. But is that enough? And isn't the fact that you only get one shot at it enough incentive to stay in shape and eat right and all that kind of stuff? But we'll talk, you know, there's people talking about, hey, this person has diabetes. If we can get them to lose some weight, the diabetes would go away. I tell you what we'll do. We will give you $5,000 if you lose 50 pounds in the next year. Would that be enough incentive for someone to exercise and get in shape? Okay, my opinion is they already had that incentive because they only get one body, only one life. But for some people, hey, an extra $5,000, all I got to do is lose weight. Yeah, wow, I'll try that. So I don't know. We can kind of talk about that, but to me, you already have a pretty strong incentive. How much more money will that change? But that's what an HSA does, is it changes the incentive now that you have more skin in the game, because now it's your money. It's not your employer's money that's being spent. So the employer would take money that would otherwise go to purchase health insurance and put it in the pocket of the employee. We're going to talk about this. If your employer is paying $15,000 to get you health insurance, and now they eliminate that, and you go out and buy a catastrophic plan that costs you maybe $1,000, they put $4,000 in HSA and they give you $10,000 raise. Is that a better solution for you than them providing you $15,000? All right. So we'll have to talk about the tax incentive of that. But all right. So the employer's no worse off. They're spending $15,000. They can give it to you in healthcare. They can give you in HSA. They can give you in salary. They don't really care. They get a tax deduction no matter what. So it comes down to what's going to give you the best incentive. So again, remember, when it comes to incentives, we're trying to get this incentive, this last part, the to them. The more we raise that to them, the more the cost becomes part of their decision in healthcare, and maybe they'll make better decisions just like they do with buying Pepsi or versus Coca-Cola in the grocery store. The third option is, what about the poor? And that's where government has a purpose. Where does the government get that money? Well, if health insurance is the largest tax hit to the federal government, and we eliminate that, the government now has $300 billion that they can do this kind of stuff with, because they're not subsidizing the richest people in the world for healthcare. So that's another approach. The wealthy may not like that, and they may cut back on their investing in other things. So obviously there's all these unintended consequences, but certainly the government itself could do this and it wouldn't change the deficits because they're eliminating that huge tax advantage on the other side. So government could purchase prepaid healthcare plans or whatever to cover it. They may still have a deductible. Maybe it's $100 instead of whatever. It's, or however you want to set that up. We'll talk about HSAs. So what is his solution then? Insurance for catastrophes only. HSA, you cannot type the word HSA. Bill Gates will not let you. It always changes it to HAS, but HSAs, out of pocket, and government plans for routine. So that's, and I say routine, the word routine, it's going to depend on that deductible. The higher the deductible, more that stuff's getting pushed down to the HSA. So that's part of the decision you got to make. If you're going to go this approach, how much is it going to be out of pocket versus an HSA? You don't have to do the HSA. You could just say the whole thing's going to be out of pocket. And then you got to think about the poor, because for a poor person, a $300 doctor bill can be pretty significant. The other thing we know for sure in this country is, you know, someone's in an auto accident. They're not going to show up to the hospital and say, we can't treat you, you don't have insurance. We're going to treat them. We don't let people just die in the streets. So you have to, the people who don't have the means to pay, we're going to still treat them. So you're going to have to figure out how to do that most efficiently. Comments up to there, you see where he's going? You can see my point here is not even offer insurance to the employer. So he's somewhat implying this is from the employer, but you could say purchased by the employee directly. It could be either one, right? Doesn't have to necessarily be. Or I'll do the second article. So the second article says catastrophic care, that's the one payer system. So he's arguing Medicare for all, but with a deductible. Well, I'll show you. His deductible is a little bit, sorry, this picture, I don't like this picture. I feel so sorry for that poor lady. So this article here. Let me see if I can find it with the dollar sign here. No, too many dollar signs. Yeah, I can't remember his number. He has HSA there as well. It's gonna be part of his solution. Right, so it's a huge number. I can't remember what it is. Let's say it's 100,000, 50,000. It's a massive deductible. So essentially what he's saying, let's say 50. So essentially what he's saying, anything that costs you over $50,000, the federal government's going to have a plan that covers you. That's Medicare for all over 50,000. So most of you would never use it at all. Pregnancy is not going to be over 50,000 bucks. Broken legs not going to be over 50. So very young people are just not going to ever need it, not ever spend it. All right. So that's a big question. Big difference between the first and second articles. First article, he says 5,000. Second article, he just goes for the rafters. All right. So there are different ways. So you have to pick how you're going to define this and what you're trying to do. It all comes back to incentives. You're trying to get the consumer to think more like a consumer and actually shop and think about costs and try to find the best plan and the best strategy for them. Oops. All right. Any comments, questions on? I got that. All right. So let's. Let me just introduce the second article and then we'll get into it probably Thursday, I guess. So this is it's an article, but it's also he wrote a book. So here it is right here, Debbie Goldhill. It's a really good book. So the article he wrote first, then he wrote the book. So he's a journalist. He's not in healthcare. He's not in insurance. He's just a journalist. He's writing about experience of his dad. His dad's story is his dad went to the hospital for something that was kind of routine, I guess, but his dad picked up an infection and ended up at the hospital and ended up killing his dad and making more money in the process by killing his dad. So he's going through that and the incentives. So it's a good book. You're not getting his book, you're getting the summary of the book, but I've read the book and the article covers it pretty well. So we're going to cover a lot of it. It's pretty lengthy. It's going to take us a while because I got a lot highlighted in here of issues he's going to cover. But his solution is eliminate the employer out of pocket. And his biggest thing is going to be this 1.77. I don't know where he got that number. I've tried to reproduce it. It's per household, but he's saying over your lifetime, your household, the average household will spend 1.77 million on healthcare, whether that's actual going to the doctor or your health insurance or Medicare premiums or Medicare taxes. Over your lifetime, you will spend 1.77 million. So the whole point of his article is, let's take that 177 and surely we can find a better way to spend it. Are there better ways than the way we're, so maybe ask the question, is the way we're spending that 177 today the most optimal way to spend it? And he's saying, obviously not. but what is the most optimal? Can we spend this money better? Does that number sound too high? You're spending a lot of money on Medicare premiums, taxes during your lifetime. Your employer, the problem is this number is hard to know because you're not spending a lot of it. It's kind of coming out of your paycheck without you realizing it, even unless you really, really look, especially your employer provided health care. So I think it's probably a reasonable number. It's old, so it's probably higher than that today if he calculated correctly. But it's not just you and your employer together are paying for that. What I don't know if he's including is the big deficit in Medicare, that we're spending a lot more in Medicare than we're going to be taking in over the next 50 years. And that's going to be a massive number as well. So what is his solution? His solution is less insurance, higher deductibles, but he does have a government solution. So for him, his solution is a government plan on the catastrophes over a certain amount. Now, you might not like either one of those approaches, but unfortunately for you, in the way I have this paper set up, you still have to talk about it. All right. So you have to talk all of these issues. So let's say you hate this approach. So you can say in class, we talked about one solution was blah, blah, blah. I don't think this will work because, right? Then you have to talk about the issue we talked in class and why you don't think it's going to work. All right. You'll see how the paper is working. So you got to cover all these issues. I want to hear your opinion. You don't have to agree with me on anything. I hope you don't agree with me on anything. You don't have to try to disagree with me, but I hope you don't. But, have some different opinions. But there's a lot of things in here. Probably going to disagree with me on the solutions. I don't know if you'll disagree with me too much on the problems because there's just a list of problems that people have identified. You may not think them as serious as problems as others. All right, so y'all ready for next Thursday? You know exactly what you're going to do. You're set up. And y'all keep me tame. So if I get ahead, y'all can stop me, all right? Slow me down, slow down, professor. I need to take notes, all right? Do you see how you can have your paper essentially done by the time we get to the due date? All right. All right, I'll stop it there. Oh, I'm sorry. Did I say? Oh, that's what you're saying, Joseph? Oh, you said remind. No, it's Friday of next week. I'm sorry. I think I put it out there, didn't I, for Friday? Yeah, sorry. I'm thinking my other class. Sorry. There should be, if I put it out there, I'll look again, but. Okay. I thought I put it out there. I'll put it out there tonight. Yeah, I'll put it out there. If y'all don't see it, email me. I'll put it out there.